Brilliant. Well, it's fantastic to be here with so many of you this afternoon who are really interested and active in the space of industrial decarbonisation. We've set ourselves an interesting and difficult but really important challenge in leaning into this space, one that's so crucial not only for net zero but also for sustainable development, job creation, vital goods and services. So really, really at the heart of sustainable development. We've got about 20 minutes now to give you some highlights from the report. We're going to do about 10 minutes of highlights, and then we'd love some questions from the audience, so please do feel free to grill us. You can download the report if you haven't got one on your seat on the QR code. And I just thought I would start with saying a few words on why transition finance, why now, and why have we done this together? So my name's Ellen Brooks. I'm a manager in BII's climate change team, and jointly with Helena, Salome and Frederick, we've pulled this report together to really focus on transition finance because, as it's been said all afternoon, we can't get to net zero just by investing in things that are already green. We have to think about the transition in the real economy. And the thing that's so exciting to me about transition finance is the fact that this now gives us an approach to investing which is robust in terms of greenwashing risk, but also credible and can really drive real-world impact. So that's why transition finance. Why now? Well, Leslie mentioned we started as BII looking at this in 2022 with some leading financial institutions from Africa, and then jointly sort of BII, but also Proparco, we looked at our first transition finance investments last year, and there's nothing like doing something theoretical in practice to really teach you how to do it properly. I think also what I would love to highlight is on this slide that 2025 was a great year in terms of a really wide range of transition finance guidance coming to the market, building on some early guidance that had already been there. So it was a brilliant sort of inflection point for us to think about what we've learned in practice, and then taking these guidances, reviewing them, distilling to the common elements. But really why as DFIs we went in on this space is because we wanted to consider what would that mean to do this in an emerging market context. So that's a lot of what you'll see in that report, some of the reflections on how to do such a nascent type of sustainable investing in an emerging market context. What the report is not, it is not a new definition of transition finance. We think there is brilliant guidance in the market, and it's all in the extensive reference list, which we encourage you to have a look at. We've really taken this definition that already exists, and I just wanted to highlight some key points. So transition finance should absolutely drive decarbonisation in the real world economy towards net zero emissions in line with the goals of the Paris Agreement. Should avoid long-term carbon lock-in, which is crucial when we're looking at some of the most high emissive sectors, and not compromise environmental and social goals. We also dig into what this means at the entity level, and there's some work on transition strategies and transition plans that I'll highlight in a moment. Where this leaves us as climate-focused investors is with two really useful tools. So we have climate finance and transition finance, which we see as very much distinct and complementary. Particularly for transition finance, this is obviously a dynamic label, so you should keep reviewing your transition finance label to see if this has resulted in real-world decarbonisation. And I think that's one of the key distinctions between transition and climate finance that we wanted to draw out. So I'm going to pause there and hand over to Frederick, who's going to talk a bit more about why this is such a useful tool for investors.
Thank you. I was going to start by arguing why it's important to have transition finance as part of a net zero strategy, but I think from the panels we heard today, that's already very clear. I think what we're talking about here are the must-abate sectors, so to speak. So high emissions today, but they're very important for economic development and are also important have an important role in a low-carbon economy as well. So it's this transition that we're looking to finance, obviously. We'll also see two of probably several benefits for financial institutions to work with transition finance. As we've also heard, decarbonizing these industries go far beyond just energy efficiency. You know, they are structural changes that companies need to go through, often very capex, require quite large capex interventions. So some of the benefits for companies to implement these changes then would then of course be, in many cases, be lower energy costs, reducing transition risks, and access to new markets where there's an increasing demand for low carbon supply chains. And for us as DFIs, there's an opportunity here for new investment areas to sort of finance these capital requirements. For us as well, it reduces the carbon emissions of our portfolio, and it could do the same for the portfolio of our investees. So it could also be a tool for financial institutions in our portfolio to look to decarbonize their portfolio as well. So one thing to keep in mind, of course, is as we make these transition finance investments, the carbon emission intensity of our portfolio is going to increase in the short term, but then over time decrease. Over to Salome for some key elements.
Right. So we defined 6 key elements for a transition finance transaction. So the first one is the eligibility of the sectors. As we mentioned, we're tackling high emissive sector, which definition may vary from hard to heavy industry. We mentioned quite extensively cement and steel, to the energy sector, to agriculture as well, which has its specificities too. And then we will need to tackle the instruments and the structure of the deals that we'll need to build up to actively incentivize the progress within these frameworks. And I will use Proparco's example throughout this whole slide to illustrate a little bit all the different elements. And I know First Ron is also here around to be able to talk afterwards on the transaction that they've done with BII as well. So this is a direct investment loan. Proparco put 150 million, along with IFC that put 250 in the cement sector. And it's constructed as a sustainability-linked loan over 10 years' time with 2 KPIs, one related to global emissions of the cementitious product and one related to freshwater usage, specifically in Mexico, which is the area that is more prone to hydric stress within the geography of our clients. So margin adjustments, as usually in the SLLs, are based on the performance with step-up and step-down margins, depending on achieving the different targets. And we've also used a second-party opinion from Moody's throughout the whole transaction to help us rate both the performance and also we'll see right after the Paris alignment of the transaction. And they gave us like a very good rating on the performance indicators and targets. Regarding the third element, which is transition strategy and transition plan, we need, as a DFI, to be able to accompany both mature and less mature actors. So basically, either we would be working with an actor that already has the transition plan, and the transaction needs to incentivize them for the implementation. Either we can also be working with less mature actors, and then the transaction will help them define their transition strategy and then implement it. And that can be done also through technical assistance. So here we had an actor that was already mature, that had already disclosed net zero goal for 2050, and that had publicly disclosed target up until 2030. And what we done with the transaction is that we pushed these targets up until 2035, both on water and global emissions, so that the company had achievable targets within 10 years and not only 5 years. The next, which is like a very key element of the transactions, is everything related to Paris alignment. As you know, we have some engagement as DFI to have our portfolio and transactions that are aligned with Paris Agreement. And with transition finance, it's not always so easy to gain some comfort regarding this. And so we ensured that both the step-up threshold and the step-down threshold margins were below the IEA cement framework in the well below 2 degrees strategy. And what we've added in the transaction is a higher up step-up margin of like 25 bips, which is higher than what the client had done earlier reimbursement on the point of inconsistency with this threshold, to give us some comfort on the fact that if they are too far away from the targets, they'd rather reimburse us earlier, and so we won't be engaged with the client anymore, rather than continuing having a transaction that is far from their Paris alignment goals. Then Ellen talked about it, but like reporting and monitoring is quite key. It's always key, of course, and we always have some impact indicators that we are following. But on transition finance, we would add up everything related to the KPI and also to the performance of the transaction also, because we are in a learning curve. It's like the first deals we are making, and we also need to have like a more cautious follow-up on like, okay, we've drafted this during instruction, and concretely, how does it go throughout the whole like life of the transaction, especially on like 10 years long span loans. So this will be super important for us to learn, and we'll happily share our learnings also with the whole industry. And last but not least, we cannot have impact without managing the risks. So we always implement environmental and social due diligence, which are also key, especially since often in transition finance, we're not only working at like project level, but we're working at the corporate level. And so we implemented a LISA during the transaction, and we also have MSCI that rated the corporate AAA, which is like top 1% of the corporates in terms of environmental and social practices, which also gave us some comfort that we could continue going with that client on a broader transaction. And I'll leave up to Ellen to finish up this presentation.
Great. So I just wanted to leave us on a few words around transition strategies. For us, credible transition finance investments are anchored in transition strategies, and we're really building on the work of the Transition Plan Task Force and other forms of guidance which really break out these transition strategies into 4 buckets. So you've got your strategic ambition, implementation strategy, metric and targets, and governance. And in the report, we go into more detail about which of these areas we would prioritize working on first with a company in transition. And I think that's a really crucial sort of part for us as DFIs, because with our pools of technical assistance and our patient sort of long-term relationships with these companies, this is exactly the kind of work we want to be doing to build out these transition strategies to result in real-world decarbonisation. And a note following on from that, really what we've said in the guidance is that to label something as transition finance, either the company would have a transition strategy at the point of investing, or because this is a younger field and we're thinking about emerging market context, we would take a commitment to developing one and work hand in hand with that company to build it out over an appropriate time frame. So really, I just wanted to close out and sort of look ahead. I think that we've learned a lot in this process of writing this guide and making our first investments, and there's still more to learn, which is sort of fantastic and why we wanted to convene everyone in this room today. Some thoughts about where we could apply some of the principles in the guide. I think there are other emerging sustainability challenges, notably adaptation and resilience and nature, where some of the principles in this guide could be really effective to help structure and make investments for increasing impact. We're also really, really interested in working with companies on the ground to drive some of this transition planning in practice, also to work more on how to set the right levels of ambitious but achievable targets that you can factor into sort of shorter term financing than net zero by 2050. So just a few areas of further work. I'm going to close it out here and look to the audience for questions, but thank you so much for joining us today.
Thank you for a very interesting presentation. I just wanted to pick up a question that we had in an earlier session from a colleague from RBC Capital Markets, which was actually in the public markets, transition bonds should hold a lot of practice as a very credible way to channel lots of capital into transition finance in practice. And I think it has been surprising that market hasn't had the kind of pickup that we may have expected over the last couple of years. And that was posed to an earlier panel, and I wanted to pose it again, that question again to the three of you to say, I mean, do you have a sense of why we haven't seen more traction in that transition bond market? And I wonder whether you made the point at the start of this presentation to say, look, there's actually been a lot of guidance on transition finance. I wonder whether that guidance all says necessarily the same thing, and whether actually kind of moving towards a more standardized definition might be helpful, but keen for your diagnosis.
Yeah, interesting question. I'm happy to kick off and then you both jump in. I guess, look, we've been looking at labelling a lot. We've been looking at all the definitions. We're telling it, yes, for the past 6 months, we've been really, really diving in. I think now there's quite a lot of consensus across all the reports we reviewed, ICMA, LMA, various banks' transition finance strategies, including First Rounds. Please see the annex, because I probably will forget one, but there was a lot of consensus, which is good, and I think that's novel. So I think some of this is a labelling challenge. Certainly the early transition bonds were called sort of climate transition or green transition, and now I think we're starting to see these areas of sustainable finance seen as more distinct. So I think once we've got that consistent label, there should be sort of more finance starting to flow. And then, not to steal a speaking point that we might talk about later, but we were on a call with First Round last week, thinking really about how the investment is going and where they're seeing pipeline, and they've just been doing a roadshow to speak to lots of hard-to-abate, high-emissive companies about transition financing, and Toby, please build on this, but the feedback from the team was that lots of African clients are really excited about the transition, the fact that the transition label has inherently built into it this climate ambition, but the ability to meet you where you are today as a company in a hard-to-abate, high-emissive sector is seen as really attractive. And actually, perhaps that's more attractive than saying you have to be already net zero emissions, and particularly in sort of an emerging market context. So I thought that was a really interesting takeaway that Hannah and I had, and I think that gives us sort of hope for once we've got, a few first movers that really set the market, credible definitions and excitement around this category, hopefully we will see finance starting to scale. Anything to add?
Thank you, Ellen. I also wanted to add maybe we've had some elements in the earlier panels as well. In the transition, there is this need of being really sector specific and also on technology availabilities. And often in the markets that we are tackling, the transition of one actor or one client depends on the technology availability that they don't have any how to say this, they don't manage when this will be available for them, and I think that's quite crucial because everything is quite intertwined. Whether when you're talking about climate finance, you have your categories, and if you are within this category, it is going to work. So I think this makes it quite different. And also maybe it is why there is also room for long-term client relationship and technical assistance, because I feel it's more of a process than being already settled into something. And when you're entering a process, especially in high emissive sector where it's quite capex intensive, you need to have some comfort on your relationship, and you need to have access to some quite a lot of financing at the beginning. And so I feel these are some elements that might help explain why it hasn't started off as we could have expected, but also maybe why as DFI we have the whole room for us also in the sector.
Thank you. Congratulations on the transaction. Very exciting. Just taking a step back, I wondered, have you always set out to do the first transaction with a bank? Or was it a conscious choice? Do you think that that's the right way to approach maybe the more challenging sectors, to start with a local institution that has understands technicalities behind the specific local individual characteristics of the market, or was it quite coincidental that you ended up landing with bank? Would you recommend to investors that maybe don't have experience with transition to start with financial institutions as the first off? Thank you.
Yeah, I can give my impression, and I'm looking at Hannah. But I think as BII, we're equally as passionate about investing in direct investments that have this transition finance capability in some of the sectors we've been talking about today, which is work that Dania leads, and equally through financial institutions. So wherever we can find that impact, and I think any of those transactions, because it's so early, would have this sort of market-shaping demonstration effect. So I think both routes can be really important. above all that, and what we did find in first round, is it's so important to have a partner who's equally as ambitious, equally as clued up in the space, equally as focused on making this work and avoiding greenwashing. And I think those are the key ingredients for success. And so, we spent a long time with first round and R&B sitting down, going through the frameworks, thinking about the emerging guidance, what would we do in this situation. We're equally sort of hand in hand now looking at pipeline. And for me, that intentional partner is probably the most important thing. I would say that's similar with first round, which we've labelled TF, but there are a number of partners in the room who we've looked at sort of climate and decarbonisation more broadly. And I would say exactly the same approach for some of the funds that we were talking about earlier, Pentagreen, BlackRock, etc. So I think that's really important.
I think you're right that you can't understate the importance of the local context and the expertise that the bank has. They have, sector experts in particular fields in the context of South Africa or broader Africa, and understand not only the bank's objectives, but also what's happening at a government level. What is the government's objectives, and how can we lean into that to get the companies to transition the way we're hoping that they will?
Great. I think we have time for one more, and then we should go into panel 2.
Thank you very much, and for the presentation of this great publication. I'm from Swedfund. I wonder if you could speak a little bit more about the work of, getting the less mature actors on the right path. And you highlighted technical assistance as a supportive tool. I would find that interesting. Thank you.
No, so I think one of the challenges we may face in implementing this methodology is the sort of anchoring that a transition plan has in this whole approach, right? Which, in terms of how detailed they are, have risen quite a bit in standard compared to just 3-4 years ago, in terms of decarbonization levers, how much will they cost, how much of a reduction will they result in, and so on. So there is quite a high benchmark in terms of what transition plans include. But I think for that, we do the Paris alignment assessment first, right? So are they on the pathway, on the right pathway? And if they're not, how far away are they from that? Is it even possible that they make it to the pathway? So I think that first check is something we would do, and then see if we can collaborate either with BII or with others to do technical assistance to see if we can help develop these transition plans together over time. Yeah, sorry, go this way.
And maybe I feel like sometimes with less mature actors, it works better to discuss the risks. And so sometimes when you start the discussion with like transition risk and how much they're exposed to this, it also helps just starting the discussion. And so they see also potential. We've discussed it in the earlier panels, like the weight of the also economic potential of the transition. And I feel like this is also a good starting point. And as Alan mentioned, we could also draw learnings from this decarbonization transition, also on like adaptation and resiliency in nature. And I feel like, especially on adaptation and resiliency, this risk entry is also a very good starting point to start discussing with our clients, especially the less mature ones.
Okay, I might wrap this section here, but huge thank you to Frederick and Norfund and Salome and Proparco for partnering with us on this report. And hand over to Dania for the next panel.